Just on a little bit of a separate note, Samir, I was going through your X feed, which I find most entertaining, and I have to ask you about this that you put up, where you say, Analyst, we had a buy on the stock, we continue to recommend a buy. We actually made a graphic, let's pull that up. So client says, but how were the results? Analyst in the voice of Salman Khan, एक बार कमिटमेंट कर दी तो मैं अपनी भी नहीं सुनता. I can't do the Salman Khan voice, but he says buy remains a buy. This I think is an important point to talk about and address, Samir.
I aimed it at the IT sector,
Yeah.
where companies have had pathetic results, broadly no guidance, and everybody say, no, we have a buy because next year there will be a 1% gain in something or a 0.5% gain in something. There's no logic. If you start from a zero base, then any of these guys would have put a buy. But because they had a buy, now they say, okay, let it continue, kind of thing.
No, but it's an important point to note. We did a piece recently about how a majority of buy ratings have not translated to anything over a year.
In terms of returns.
In terms of returns.
No, but that is okay. But go beyond that. That if you have two bad results, you reduce your EPS guidance, you reduce your own EPS estimate by 5-6%, and then you say doesn't matter, buy still continues. So in Alliance, when I was there as an analyst in the 90s, the rule was that if you cut guidance, if you cut your estimate by some X%, 4-5%, you have to change the this. You can't say it doesn't matter. It's 5% less. How does it matter? Because we are long-term guys. That was the rule for being sort of not active, but to be whatever's the word. That you can't just generally let the buy be separate and the analysis be separate.
Okay.
No, so
coming back to IT. Back to IT, because that's an important one. No one can quite make up their mind. There is enough commentary which shows some positivity on IT and Indian IT, but the numbers are just not matching up.
No. I'm saying you look at those numbers and you make them positive. You take these guys' positive number and then say what is the valuation, what is the growth. Okay, instead of going 3 to 4, I will go 4.5. Now that is positive as per the market for 2 days. That because you have outperformed. But the point is at 4.5, why should you? How much will you give? Okay, make it 7%. Make it double of what the estimate is. What should be the PE for that? I mean, look at the Google P there. It might be 16. You do it SOTP, it might be 10. And here we are saying that doesn't matter. 25p is good because lever is 50.
No, so how are you looking at IT right now, Samir?
So we don't look at it much.
Yeah.
We don't look at it.
Completely underweight IT with all the numbers coming.
It depends on what you like. We have one stock, which is KPIT, which we also have kept. Although that also hasn't done much in the last year or so. Yeah, otherwise we don't have. Unless you call Indigene IT, okay, we have it. Depends on classification, but yeah, nothing else.
So ER&D is something that you're liking?
No, it's not like even that. That is a big concept. Look at the results of these other companies and how they have done. So you can call it one company now, whatever category you want to call it, because my general big picture thesis was, we don't like generally auto, we don't like a disruption by EV. But here he's assisting the disruption. Assisting the disruption is okay. Being disrupted is not okay. And basically, IT sector itself has been disrupted. What to say? IT sector itself is disrupted right now. People don't want to believe it's been disrupted black and white. You can see it in every result, every company.
What about the new age tech companies? Swiggy, Zomato, would you still look at them from a positive view?
Absolutely. But before that, they are not really tech companies. Tech company would mean that, they are basically, because what people don't understand is how difficult it is to, in real life, have 300,000 restaurants and 300,000 agents, and every minute they have to be busy, and every guy has to be delivered what was ordered, and there should be less complaint or zero complaint. Everybody should get it in 25 minutes and then go to the next guy and in Blinkit deliver everything in 10 minutes. It's a massive exercise. And so people think of it, oh, he's just delivering food to you, but that is not the way. It is an extremely complicated business. And we like Eternal more just because we have it in a bigger position. And by the way, we have just made 5x as of last week because we bought at 52. But the point there is, there are very few pockets in India where you don't have to rely so much on the end growth of the industry. You are relying on the change in buying habit. And at a very small percentage move, it has reached like maybe combined this whole industry might be a $10 billion value, and whereas the market might be 500 billion or something for grocery and retail and all these things. So it's a very small shift, but you are still not depending on some unknown random this thing that the growth will be 8% and you will get new orders from somebody or something. It's a day-to-day business with the convenience being highlighted again and again because of too much difficulty in dealing with India every day in terms of traffic and pollution and weather and heat. And on the other hand, for whatever reason, very comparatively available labor. Now, if the world doesn't want it like that, there's nothing we can do, but that is a model perfect for India.